Okay. All right. You can see the slides?
Yep.
Okay, perfect. Okay, yeah, just quick intro about myself. I've been plugged into the startup space here in Singapore and the wider Southeast Asia region for a few years now. I had a startup back in 2018, which I worked on for about 2 years. It was a startup in the media space. We built a platform to discover movies and TV shows from multiple streaming services in one place. Made a lot of classic first-time entrepreneur mistakes and closed shop about 2 years later. After which I was in marketing for a while with Dentsu, one of the larger Japanese agency groups, where I started B2B performance marketing for some enterprise clients. And the past 3 to 4 years, I've been back once again into the startup and venture land in this part of the world through a community that I started called Curate. So that's a community of over 1,000 members that are all founders and investors in startups. They're generally early to mid-stage companies. So think pre-seed to Series B, and the investors are a mix of VCs, angels, family offices, accelerators, incubators, and so on. So we've done about 40 plus events the past 3 years, connecting founders with like-minded founders and founders with investors. And that is how I ended up meeting the Capita team. I joined Capita just last year, so it's about a year now. Capita itself is a Series B startup that started out of Singapore. About 6 years ago, we have raised north of 50 million. We've acquired two companies, and we have offices across Singapore, Indonesia, India, US, and clients all over the world. So I'll tell you a little bit more about Capita in a bit, but that's an intro about myself. Yeah, I've been based in Singapore here for a few years now, and Plug and Play is a great partner of ours. We've done a number of sessions for the different cohorts, the programs they run. Some of them have become customers as well. And yeah, look forward to having all of you at the APAC summit this year, and we might plan some more in-person engagements then as well. So with that said, so today's session was, I think, roughly three categories. Quick intro about Capita, and then we'll touch upon some basic concepts around cap table management that all of you as founders should be aware of when you're evaluating term sheets and having conversations with investors, as well as ESOPs, which will be bulk of our conversation today around issuing equity as a form of compensation to employees, advisors, and so on, right? Okay, starting with Capita. Capita, as I mentioned, we're Series B company right now. We are in the equity management space. So cap table and ESOP management is a SaaS product that we have. That's our core business. We also have a bunch of services around that. Like we teach companies how to design ESOP schemes and what are the benchmarks in the markets and how do you manage the different local regulations. And we also do valuations as a service for companies. And we specialize with ESOP valuations, but we also do a whole gamut of valuations and work with auditors as and when startups grow and scale and require to have financial audits done. So yeah, that's Capita. We started in Singapore. We're headquartered over here, but we have a large team in India from the two acquisitions we have made. And we also have a secondaries marketplace where think of it like a private stock market. So you can buy and sell blocks of ESOPs of companies, and employees can also trade their ESOPs on the platform. So yeah, that's a business that's mature in India, but it's still picking up here in Southeast Asia. So that's that. These are some of the companies we work with. We work with over 50 unicorns, over 100 public companies. We've designed over 1,000 ESOP schemes. And yeah, collectively manage over 16 billion in ESOP value for all these companies combined. Okay, so coming to cap tables. So just as a structure thing for today, feel free to pause me at any point and ask questions. But otherwise, we can have a good 15-20 minutes towards the end for Q&A. But feel free along the way as well. Okay, so cap table is essentially a capitalization table. It's an accumulation of all the transactions that have happened related to shareholding, share transfers, share issuances within your company, your startup. And essentially, there are two types of transactions. There are primary issuances and there are secondaries, right? So primary issuances are when you create new shares, right? And secondary transactions are when you trade existing shares, right, between two different owners, right? So primary transactions are when you onboard, let's say, a new investor, you issue new shares to them, you dilute the older ones, and you issue new shares. Secondary transactions is if the investor wants to sell their shareholding or a part of it to, say, future investors, that would be a form of a secondary. Or if you as founders want to sell a part of your shareholding as and when you fundraise or there's a liquidity event, those are again examples of secondary transactions. And finally, every transaction at a very basic level has a certain class. So what type of share are we dealing with? Every share is not created the same way, right? So investors typically, when you raise VC money, they would expect certain rights, right? Which we'll get to in a bit. So different shares have different rights. US founders have certain rights. Employees have different rights, right? Voting rights, board control, all of that. As well as just basic details around the quantity of shares, the amount, the documents attached to it. These are the kind of things associated with every transaction, every share on your cap table. Okay. Yeah, so coming to all the different instruments that you should be familiar with as founders as you go about having conversations. Just a quick check. Like most of you are running startups around the pre-seed seed stage, if I'm right? So you have raised some amount of capital from early investors, or are you raising your first round right now? Maybe Taryn can fill me in on the
So,
context.
so actually,
Yeah.
a lot of them are in the Series A and above category.
Oh, perfect. Okay. Perfect. Yeah. Okay. So that's our sweet spot. Then I think it's the perfect time to familiarize yourself with especially the ESOP side of things. The cap table, I would assume, since you have already done a round or two by now, you should be familiar with these terms. So I'll kind of gloss over that, but then ESOPs will be the main focus of today's conversation. So typically, what we see is the sweet spot for us is around the seed stage or pre-A mark, right before your first institutional checks is when most startups consider implementing an ESOP scheme. Because the early stages is all about survival. You're still figuring out whether your co-founders are fit and all of that. But ESOPs as an instrument work only once all of that is in place and you have a few employees, you have a few key team members that you want to retain and you want to attract great talent from other startups or competitors or larger companies to join. You typically need some sort of equity compensation in addition to salaries as well. So that's perfect that all of you are already kind of beginning that growth stage around that A mark. So that's great. Okay, so in terms of the different instruments, there are ordinary shares, there are preference shares. So ordinary shares are typically what you hold as founders. Preference shares are what investors get. And even within preferences, there are different types, there are different terms, which I'll walk you through on the next slide. There are convertible notes. Safe notes are the most common version of this simple agreement for future equity, something that Y Combinator popularized, I think about 10, 12 years ago. And now there are localized versions of this in every market that make it easy to raise capital, especially when you don't know the valuation of the business. So I'm sure some of your early rounds, you might have used safes as instruments and they may have converted or not by now. So again, something to take note of in terms of what are the conversion terms when they actually become shareholders at a certain valuation, right? Differential voting rights. Again, some investors may want board seats, may want different rights, especially around the Series A mark. Some of your lead investors may definitely want a board seat. So familiarizing yourself with those things are also super important. Finally, you have warrants and options. Warrants not so critical unless you're actually considering M&As in the near future, but options I'll walk you through in depth in the second half of today's session. Okay, in terms of investor rights, liquidation preference is so liquidation preference, anti-dilution, the terms, participative rights. I'm sure you've seen all of this in the term sheets from your existing investors already. But just to quickly revise, liquidation preference essentially is when investors come in at a certain valuation, they want to make sure that that you actually, as founders, grow the business, right? As opposed to selling it for far less than what it's worth, right? So, as a simple example, if your company's worth 10 mil, you raise say 5 mil, now it's valued at 15 million. What stops US founders from turning around and selling the company for $1 million, and you still own, let's say, half of it? you can still walk away with $500,000, right? That's typically not how it works because of the concept of liquidation preference. So when investors come on board, they typically have a multiplier, right? Which is like a 1x or 2x kind of liquidation preference. I've heard as high as 3x, which is a little crazy, but essentially that states that in the event of a liquidation event, the investors would be entitled to at least 1x or 1.5x or 2x of their investment, which means you as founders have to raise the company's valuation by more than that for you to walk away with any money. Which is why we see a lot of exited founders in the in the venture world over here who would be celebrated as exited founders on paper and the media, but if you know them personally, you would know that they may not have made any money because of this concept of liquidation preference. Super critical, especially as you raise larger rounds around the Series A and B mark. And a lot of macro conditions also become super important over here. I'm sure all of you have seen companies that raised in the peak 2022, 2023 era that have not been able to raise more money because of this concept, because the more money they raise, the more they have to raise the valuation, and it just doesn't make sense beyond a point, right? Anti-dilution are terms typically to protect older investors. So essentially, it dictates that in the event that future investors come on board, how would the shares of the older investors be diluted? So there are different terms. There are also participative rights where you can offer older investors a chance to participate in a future round to maintain a same or similar level of ownership. The most common version of this is pro rata rights, where you have to offer existing investors a chance to invest in a future round as a mandate. You have to keep them informed and give them that option, right? And conversion terms, as I shared with Safe Notes, there's typically a valuation cap, valuation floor. Valuation cap is a little bit more common, which dictates that in the event that the Safe Note converts into shares, what is the maximum valuation at which that will happen, right? So that they maintain a meaningful stake in your business. So these are the terms that investors typically look at, and as founders, you should be super clear with all of this when evaluating term sheets, especially liquidation preference and conversion terms if you're using Safe Notes. Okay. All right, moving on to ESOPs, right? I'm assuming that none of you have equity compensation right now for employees. If you do, you can share right now. If you do, be curious, but I'm just going to assume that that none of you have implemented ESOPs yet as a company, right? Okay, so I'll take that as a yes. Okay. So with ESOPs, most people know of ESOPs as employee share option plan, right? Stock option plan. While that is one instrument, options, actually, it has a broader definition. So employee share ownership plan or program is the broader definition. And options are one instrument, but there's a whole gamut of instruments, which I'll walk you through on the next slide. So the idea of equity compensation is it doesn't work in isolation, right? This is just one instrument that has to fit within the larger vision and culture and hiring recruitment strategy that you have as a startup. And it is something that as founders, you might want to attract really, really great talented people. You may not be able to pay them market rates. And equity compensation can be a great way to make up for that. And especially for people who have been part of one or two startups before, who may have seen exits, this is one of the first things they'll ask you because they know that the name of the game in our world, that is venture capital, is equity, and salaries may be similar to other companies, but the real value can be unlocked only when you have equity in the game, skin in the game, right? So that's the basic idea of equity compensation. It's just one instrument, and of course, we as a company specialize on that. But it's one instrument in your wider toolkit in terms of culture and people strategy and talent attraction, retention strategies that you have as a business. So we'll go over basic concepts around plan design, best practices, local regulations to take note of. Employee engagement. So you can have a great plan scheme in place, but if employees don't take it seriously, they're just going to ask for a raise every year. And yeah, if they don't take it seriously, it's a chicken and egg, right? So why should you issue more equity if employees aren't taking it seriously? And this is a big issue in honestly our part of the world where we haven't had all that many exits, and so employees, unless they've really been part of companies like a Grab or Property Guru or a Gojek and these kind of companies, they don't really value equity compensation because the chances of a liquidity event happening at that scale are so far and few that we're still maturing as an ecosystem, and people are still figuring what is the real value if there's no liquidity in the market. So this is a bit of a challenge, but the more you communicate it, the more you ingrain it as a culture, the more seriously they'll take it. And once as founders, you actually give them access to some liquidity, let's say in a future fundraise, you set aside some cash to buy out early employees, investors. The more they see that liquidity, the more engaged they are in the game, right? And finally, regulatory and tax environments, some key things to take note of from both an employer and employee perspective in key markets around Asia. I'll walk you through that. And if you have specific questions around that, happy to take that as well. Okay, so yeah, benefits of equity compensation. Essentially, any seasoned leader would know the value of alignment in a business, right? So aligning your employees' motivations with yours as a founder and as a business and as investors is super critical. Equity compensation can be a great way to do that, and it allows employees to participate in the upside in the event that you create a buyback program, or you go through an M&A, or of course you one day take the company public. The value that can be created is immense, can be life-changing for especially early employees. And yes, it's a great tool to retain and engage employees. So this is an example of what it can look like from an employee's perspective, right? The value of equity compensation. While there's salary, cash salary can increase by a certain level every year, the real value when they're taking a risk to join your early stage startup is in the equity. And this is an example of how that value of the equity can increase if, let's say, you raise a Series B in another 2-3 years. This is how significant the jump can be from the employee's perspective, which means it's a great way to retain them, because typically they have to stay in the company for a long enough period of time to realize all these gains, right? And every year you can issue more equity so that you reset that time period every time, and it's a great way to keep everyone engaged in the game. Okay, I'll skip through this. Okay, this is my favorite slide in the entire deck, which is all the different instruments that you should be familiar with when it comes to equity compensation. So options are the first, the go-to. It's the most common for a variety of reasons. So options are essentially the right for employees to purchase a certain share in the company at a certain point, right? At a certain price, right? So when you issue options, there's no actual share transfers that's happening. It's very simple. It's like a safe. It's just an agreement, and it's only once a certain a time period is hit would they have an option to exercise those rights and actually convert to become shareholders, right? And there's typically a vesting period associated with this, which means when I issue options today to, let's say, an employee that's been in the company for 6 months or 1 year, I issue them options. The vesting period is typically 3 to 4 years. In some cases, you might see accelerated vesting of 2 years, or if, let's say, you're giving options to advisors and their value is only for a certain period, it could be as low as 1 year, but the norm is typically about 3 to 4 years. And there's typically a 1 year cliff, which means that if they leave within 1 year of issuing the options, all of it is clawed back and they don't walk away with anything. But let's say they stay for at least 1 year, then they would vest 25% of it, right? And after that, the vesting could be faster. It could be every 6 months. It could be every month. It could be even day-wise vesting, right? It can be as creative as you like within that remaining 3 years of the 4, right? So key thing to take note of is when you issue options, there's no actual share transfer that's happening. And it's vested over 3 to 4 years. It's an option for employees to participate, but there's no actual shares issued upfront, which means it's very easy to claw back in the event that they are not in the company. So that's options, and typically So options are common with early stage startups. RSUs are restricted stock units, right? This is more common once you hit that Series B, Series C mark, is when you issue RSUs usually. So RSUs are restricted stock units. They are essentially, they have an automatic conversion, which means the moment I issue RSUs, they have the same vesting period. But as soon as the vesting schedules are hit, they automatically convert into becoming shareholders, as opposed to having an option and having to buy in at a certain price. With RSUs, the they naturally become shareholders. There's no price to pay. The shares are just issued, right? This is typically common with later stage companies because it minimizes downside for employees, right? Which means I'll give you an example. I was part of a startup that was one of those unicorns, a $1 billion company that went completely bust about 2 years ago, and we had RSUs, and the RSUs. This company, for instance, listed their IPO at was $10 a share, was a SPAC, and it went completely down to 1 cent in about 6 months. And now they're bankrupt. But RSUs are still worth something because I didn't buy into it. The RSUs, depending on when you sell, are still worth something because as long as you stayed in the company for a certain period, they would be converted, which means you're entitled to whatever the share is worth. Whereas an option, because you actually bought into it at a certain price, as an employee, you are incentivized to actually increase the value of the business because otherwise it's not worth anything. In many cases, in Singapore-based startups, you can issue zero price options, zero cost options, which means they don't actually buy into it. But typically, there's some sort of a nominal rate with options that's associated with it. So that's options versus RSUs, right? Options is employees buy in, which means incentivizes upside. RSUs it's just given, so it incentivizes them staying, and it's more for later stage companies where you're not that tied to the mission as early stage employees. And within Silicon Valley companies, it's a norm that for every 3 options that are issued, you kind of throw in 1 RSU, and as you scale the company, that ratio would swap into more RSUs and less options. PSUs are performance share units, which are the exact same as RSUs, except instead of it just being time-based vesting, it's also tied to performance conditions. So for instance, if you hire a head of sales, there are certain revenue targets, and depending on how much of that is attained, the shares would vest differently, right? Same thing can be done with options, by the way. So even options, you can have time-based and you can have performance-based or some combination of both, especially for early stage startups. It's something to take note of that you don't have to do it all time-based. You can actually tie it to tangible metrics depending on the function and role. So yeah, that's options and RSUs and PSUs. I'm going to skip number 4. I'll come to shares in a bit. I'll just jump to number 5, which is SARs, SARs, and phantom shares. So SAR is stock appreciation rights. So this is essentially, think of it as fake options. As opposed to all of these instruments which are equity settled, this is the only one that is actually cash settled. What does that mean? So that means as companies, when you issue equity, right? Let's say the company goes down, you can't raise a future round. That's fine. It's just equity that's issued, and the equity is not worth anything. That's fine. But with a cash settled instrument, right? You're not actually issuing equity. It will look and feel like equity for employees. They can log into a portal, they can feel like they have shares and all of that, but at the back end, it's actually cash settled, which means that in your accounting, this is actually an expense you need to account for, right? So the value of these shares over a 4-year period would be amortized, and it's something you have to account for and have to have the cash balance for, which means you can't invest that in growth of the company, right? Why do you use this as an instrument as opposed to issuing equity? Well, one, you want to maintain more control of the company. You don't want to dilute it as much. But the more important reason is in certain markets, if you have employees in, say, Philippines, Vietnam, China, these are countries where it is a little difficult as foreign companies to deal in equity, right? You have to get state bank approvals from the local securities exchange. And so we typically advise startups to go with share appreciation rights in these certain markets. Or the other option is to issue these instruments from the Singapore entity, your holding company, in which case you can bypass some of it, but it's still tricky to deal for the employees to deal with it from a taxation standpoint. And so we just advise to go with a cash settled plan in those markets. And for the other markets, you want to go with equity as much as you can so that you have more cash to invest in growth. So those are phantom shares. You can think of it as it's essentially just shares on Excel. You can be as creative as you like with the structuring. You can use principles of options, RSUs, whatever you like. And for the employee, it makes no difference. They would still feel like shareholders. All of that is still the same, but they don't actually get shares, and there's no dilution. There's no impact on your cap table whatsoever. Finally, shares. The reason this is the last I mentioned is from an equity compensation standpoint for employees or advisors, this should be your last option. You don't want to issue shares directly. Honestly, even between co-founders, right? Most of you would have a reverse vesting type of schedule. So in the event that people leave, it's very difficult to claw back shares the moment they're issued. So that's why you want to be using one of these other instruments because you can have conditions, you can have a vesting schedule. Whereas with shares, it becomes very difficult to claw back. And I'm sure all of you have seen friends and associates in the space. Once they issue shares to whether it's an investor, employee, or co-founder, it is very difficult to negotiate and actually claw back and come to some sort of an agreement. And even if you do, it would, from an accounting standpoint, your company would be impacted because you would have to buy the shares back at a certain price. So shares is typically the last option. You wanna use the other instruments as much as you can, and also from the employee standpoint, the moment you issue a share, most governments view this as a form of I'm giving you an asset today, which means that's a tax liability instantly, right? So with all these other instruments, you can actually delay the issuance of a share by using all these other terms and delaying the actual share issuance. But with shares, the moment you issue it, they would be implicated from either a cap gains or income tax or both instantly. So that's also a reason to avoid using shares as much as you can. Obviously, investors is a different story, but for advisors and employees, this should be your last option. So that's equity instruments. I'll just pause here for a bit. If you have any questions, happy to take that, or I'll move on. All good? Okay. So these are some more details around things like tax considerations and how you should go about thinking about how much of an equity pool to set aside. A lot of this comes down to the culture you want to create as founders, right? For some founders, these things are super important. What we have noticed is founders who are on their second, third startup, who have done this a few times, they think about these things early on. They think about corporate structuring, they think about taxation, they think about equity compensation early on because they really understand the value of having the right people on board. Whereas most early stage first time founders think about these a little too late. But typically around the Series A, Series B mark, you do need to get this sorted because any institutional investor would ask you if you have an ESOP scheme in place for two reasons. One is it's a great tool to attract talented folks from other startups, and you should be able to do that as a founder. It's one of your main jobs as a CEO is to attract and retain people. But also just practically, when you create an ESOP scheme, you need board approval and it'll have a dilutive impact on all the other shareholders, right? So the investors naturally want to come on board after the dilution has happened and not to be diluted after they come on board. If you create an ESOP pool that is 5-10% of the company, their value of their shares would go down because they are new share issuances, right? So that's the other reason why most institutional investors, they would ask you whether you have some sort of a ESOP scheme in place before they invest large chunks. So pool size is a key consideration, and this is something that really comes down to the philosophy, the markets that you're in, how seriously employees take the equity, given the liquidity in local markets. From what I understand, Korea is much better than Southeast Asia from a liquidity standpoint. Because of how active folks like corporate venture arms are, and the overall public markets as compared with Southeast Asia, where even our largest exits have been essentially SPACs on NASDAQ, not even our local exchanges. And most of the large exits like Grab, Property Guru, Gojek, all these companies, they haven't been great, right? 3, 4, or 5 years post listing, they haven't been great. So no outlier successes. And so that means the ecosystem is still maturing. So the awareness on these instruments isn't as high, but we're still very excited. And the right startups implement these things early on because the more you delay it, the more difficult it gets to get all the approvals from the other investors, shareholders, and implement such schemes. In terms of coverage, this can be Again, comes down to your philosophy. Do you want to have a broad-based plan like what we do here at Capita, where even the most junior employee, if they stay for a year, they get a small chunk of ESOPs? Or do you want to have it as only your senior management? Again, just different philosophies, different leadership styles, and it comes down to what your overall total rewards and benefits program look like for employees. The grant frequency as well is do you want to issue equity at the time of hiring, or do you want to wait for a year? And even once you do you want to have more like a top up of ESOPs every time as part of appraisal cycles is also something that you can think about as founders. Again, it comes down to your philosophy. And the quantum itself, how much ESOP should I give? This is something that we have a lot of data on. We have a report which I'll share with you about later. But again, comes down to the markets you're in, as well as what the salaries are at which they're coming on board. And typically, it's some sort of a multiple on their cash compensation that is paid in equity. Could be 10, 20, 30% of their cash salary that is issued as equity that vests over 4 years, which has a chance of 10xing in value, but at the time of issuing, it could be 20, 30% of their salary is what we usually see. So that's that. In terms of routes, I'm sure some of you are already familiar with the concept of SPVs, special purpose vehicles. This is essentially a collection of investors, right? It's a separate company that sits as one entity on your cap table to keep it clean. SPVs are used to bundle up, say, angel investors or early investors, and it can also be used to bundle up all the shareholders in the ESOP pool, right? So a lot of companies decide to create an SPV that acts as their ESOP pool, and that sits cleanly as one line item on your cap table, but actually might represent a bunch of shareholders that have actually converted their ESOPs. The reason you want to do this is in most markets, there's a limit to how many shareholders a private company can have. In Singapore, if you have a holding company in Singapore, it is 50 shareholders is the limit, which you can very quickly hit. So you want to be using these structures as much as you can early on. Yeah, that is that. Yeah, I can come back here if you have more specific questions. Finally, I want to end with 3 different resources that we have here at Capital. This is a free resource that is on Notion entirely. I'm sure all of you use Notion; it's my favorite. And you can sort investors by the stage they invest in, the sectors they focus in, the geographies, and you have direct access to the people, the key decision makers in each of these funds, and you can view some of their popular investments and so on. So yeah, this is something that if you just go to the Capita website, click resources, you'll see it. We put this out earlier this year, and we're very proud that this is the most comprehensive list right now in this region. Next is our equity compensation trends. So this has a bunch of benchmarks on things like I shared with you on, what are the most common instruments? What is the typical pool size of ESOPs that we're seeing in the market? How do you go about different regulations in this part of the world? It's all covered in our 2025 report, which is going to be launched next month. So we'll be having some launch events across the region, but it will be a free resource that will be available to download online. So keep a lookout for that. And we'll also share with you over email once these are launched. Finally, we also have ESOP guides for Southeast Asia as a whole. So this covers key regulations, taxing points, advice on how to structure these instruments, and both equity-based, cash-based instruments. All of that is covered for 6 different markets in the region where we see companies that usually hire. And yeah, this is again a free resource that will launch next month. So keep a lookout for that. So yeah, that wraps up the presentation for today. I am happy to take any questions that you have. I'll do my best to answer any super specific local questions that you might have. And if I don't have the answer, I can always check with our consulting team and get back to you over email.